All right. We are in chapter 7, the Loanable Funds market. So we, chapter 6 talked about the labor market and its relationship to long-term economic growth. I said we were going to look at 4 different markets to try to gel together the macroeconomy. And last time we started in on the loanable funds market. Now, who were the agents or players in the loanable funds market? Households, businesses, and government. So all 3 of them. Now, which one were the borrowers and which ones were the lenders? Business, government, households. I hear a bunch of answers, and that means you are correct. They can all be any of those things. I then identified that on average, on the whole, households are supplying the funds, businesses are borrowing the funds. But in reality, you can be on both sides of the fence. So that makes this marketplace a little more unique. So today I wanted to start off by thinking about the flow as it relates to our buckets and flow material, and think about the importance of capital decisions versus consumption decisions, because ultimately there's an intertemporal aspect to this. What does intertemporal mean? That's kind of a big fancy word. It's kind of fun to say. Anybody want to take a stab? There's an intertemporal aspect to consumption and or savings. Intertemporal, temporal, what does that mean? What's it related to? Anybody want to take a stab? Begins with a T. Time, over time. So there's some substitutions that are being made. So economists think a little bit differently about savings than maybe the average Joe. We think of it as maybe current consumption versus future consumption. So you might be deferring consumption today. So over the course of 2013, you can buy some Twinkies and beer and pizza and other stuff, right? Our consumption goods. But if you save your money and you tuck it away on an individual basis, why are you doing that? You're doing that to engage in some future consumption. So there's this temporal aspect of the timing of consumption. Savings allows you to consume more today or tomorrow compared to today. So there's this trade-off of timing that we'll see coming through. And the same is true for government. We mentioned last time the government deficit. How did that come about? How does a government deficit come about in general in a given year? We are taxes and spending. How are they related? Tax revenues less than what's being spent. We're not bringing enough money in the form of tax revenue compared to what's being spent. Therefore, we're short. We can't buy that extra warhead that we'd like to keep in our arsenal. Or we could borrow and still get it today, right? So the borrowing, the government borrowing comes in. Now that's taking resources away from the future if we're borrowing from tomorrow. So there's this timing aspect that's important, especially in the loanable funds market. All right, so back to our basic theory here. The wealth of our nation at any given time frame is really ultimately determined by our resource base. What do we have in our buckets of land, labor, capital, and entrepreneurship? All right, so capital is kind of the focus here. Here's a tractor somewhere in Kansas. We're doing some haying, right? We've got land, labor, capital of the machine, and maybe our laborer is also our business owner, our farmer. So all these basic resources in the production of some type of good. We've shown how the buckets change over time through additions and subtractions to each bucket. We're ultimately interested in economic welfare through the real quantities of goods we produce over any given time frame. We can maximize the quantity of those things by specializing in what we're good at. Just like how Tom and Jen did on the island. Jen was our fisher person and Tom was our coconut harvester. That on the big macro economy comes to us through people grouping together and doing what they have a comparative advantage in. There's our market without the government. Spending on stuff at Walmart and other places on final goods and services equals the income generated by allowing those resources to be put to those productive uses. So the households own all the resources. These guys rent them during the course of some time frame and produce the things we want. A big master engine of exchange to where the parties involved can hopefully increase value, both on this side and this side, but more importantly, all of the people over here reside over here ultimately. Enter the government. We need a government for rules of the game, for instance, enforcing laws, all kinds of issues, the provision of public goods like national defense we've been mentioning. So they take money to provide those services through two sources. There's only two sources available. Through the resource market off of income, an income tax, or a consumption tax, the sales tax at the cash register. Those are two sources of tax revenue, and then we go about spending that money. If the tax revenues collected are insufficient to fund the spending on various activities of the government runs a deficit and needs to borrow. The rest of the world, imports and exports, we've got the government. Now there's our cigarettes. All of our activity on our island, since we're the United States, we're trying to keep track of our economic activity. C plus I plus G plus X, consumption, investment, government spending, and net exports. What we sell to the rest of the world minus what we buy from them. Here's the new one we haven't gotten to. So that was all kind of a quick overview, run-through review. We're adding now a financial market to the system. So this is figure 2.8 on your sheets. If you want to pull those out, you might jot some notes down as we go through. So the new thing that we've added to our system is the ability of households to save some money rather than buy the Twinkies and beer. So here's our consumption flow. We could have bought something from China and did some imports. We send our money to Roe, or we send our money to an American firm. So we've got consumption taking those two forms here in the goods market. But we can also defer consumption to a later time frame by saving our money and throwing it at the financial markets. All right, so the households end up being a source of loanable funds, funds that can then be used by some other agent in the economy. We mentioned before that some households are saving money, but other households are running up credit card debt. So they're on both sides of the fence. So that there's kind of flows that run each direction potentially here with the households. All right, then our other players. The government potentially could be adding to the financial market as a saver if it collected more tax revenue than it spent, which we know, and we've said multiple times, it doesn't do for the most part the last 30 to 40 years. But if they did, they'd essentially be supplying funds to the market. The deficit, however, sucks funds away. The rest of the world is our other player in the financial markets. If we don't sell as much to the rest of the world as what they buy from us, I think I said that wrong, but if exports and imports, how does the U.S. trade balance look? What did we learn from chapter 15? What's bigger, exports or imports? So we got cigarettes, C plus I plus G plus X. The cigarettes part was exports minus imports. Does the United States import more or export more? They import more. So we have a trade deficit. A trade deficit. That's different than the government deficit that we were just talking about. So sometimes this is referred to as the twin deficits that the United States has been doing for the last 30 to 40 years. We've typically had a government deficit, and we've typically had a trade deficit. So in the United States, the last 30 to 40 years, imports has been greater than exports, making this expression a minus sign, right? All right, well, what was one of the things from international trade that I said about imports and exports? They had to be equal in the aggregate. What I sell to you is what you bought from me. So if we look around the globe and we think about that, imports must equal exports. Is that going on in the United States? No. Another level of complexity. So how do we continue to buy more stuff from the rest of the world than what they buy from us? We borrow from them. So we are borrowing from the rest of the world in the grand scheme of things, in the sense that the Chinese can buy funds, buy US denominated financial assets. They can buy stuff that has US value, US financial assets. We'll get to there in a second. I just wanted to point out that it's not like we're just necessarily going out and get a loan, but the Chinese are investing in us. They're buying our financial assets. They're supplying some funds. Okay. So that's our three players then in the financial market. In the grand scheme of things, we've got the rest of the world to reckon with, to reconcile if imports don't equal exports. If they do equal, then there's no effect, by the way, right? If imports equal exports, if we have a balanced approach going on there, then there's nothing going into affecting the financial markets in that regard. So where's all this money going? Well, there's a company over here that ends up being, as a group, a net borrower of funds. So this FB is firm borrowing, the firm's borrowing coming back to the businesses. So businesses are net borrowers of those funds. Okay, so here's the decision at hand. Here's our little guy on our island here making some money, right? You got $100, and you've got choices to be made of consumption or savings. So one of the first things that I want you to write down is this little equation. We're going to take our income and partition it, for starters, into two spots: consumption and savings. Now this is income after tax, so this is going to be disposable income. I'll write this out. So I put a subscript D there for some notation. Disposable income, which is income after tax. After income tax. We'll even specify the tax since we talked about a couple taxes. After income tax. So since I'm kind of running this train of thought down, I don't know if this is the cleanest way to do it, but y minus t equals yd. Gross income minus taxes gives me the amount I can go blow at Walmart or tuck away in my piggy bank, right? Income after taxes. So there's your gross income, which is really GDP, because income equals spending. Gross income minus tax gives me my disposable income. I'm going to separate that income into two parts for now. Consumption, which we know the C from earlier. Consumption goods. And then we're going to allow the household to have some savings. On our flows, that's right here. We're going to consume our money or we're going to save our money. One of those two places. We're ignoring imports for now, by the way. All right, so let's track the difference of this decision in the economy. So we got $100. This particular consumer, we're saying 90% of the income is going towards consumption, 10% towards savings is their particular game plan. So with the pizza, the consumer buys the pizza, it turns into consumption. So we flow through the goods market and it hits C. That goes to Pizza Village in town, right? Pizza Village pays its employees for all of the cheese supplier, the dough, the laborers that worked it, and finally maybe if there's any profit left over for the entrepreneur, all of that flows back this way. So that's kind of the progression through the system, right? Well, what happens if we dump it in the financial market? So if we come this way, we're going to be savings hitting the financial market, and ultimately that might turn into a tractor. How does that turn into a tractor? Because there's a whole bunch of households that are contributing enough savings, not just $10, but 10 times 100,000. There's a lot of money sitting there potentially. That money is being borrowed by a farmer down here and ultimately getting a tractor into production in our society. That tractor company, John Deere, or I guess this is what, maybe an international tractor there, they pay their workers, they pay the steel, the person who supplied the tires, all of that flows through. So in the grand scheme of things, at a snapshot in time, fundamentally there's not much difference here of how that decision turns into other people's income, right? See where I'm going with that? So whether you choose pizza or you choose savings, in this kind of first round, it flows back into some people's pockets. Now it does determine whether John Deere gets your money or whether Pizza Village gets your money, right? And they have different employees that work for them. So it goes into different pockets. But again, stepping back and looking at the big picture, we get it all flowing back here in the form of income in some way, shape, or form. All right, questions on that? So there's the difference. We start to think about what goes on today. So here's my picture again that used to have pizza, shirt, and a basketball. We've kind of transformed the production process and we're saying, nope, not a pizza, but there's a tractor. Ultimately, that $100 keeps GDP the same either way. What about tomorrow? How is tomorrow different than today, or is it different? How is tomorrow different? Okay, good. So there's some persistence to the tractor as opposed to the pizza, right? The pizza's been long pooped out. Okay, it's gone. It helped with some nutrition. There was some caloric intake. It gave you some energy, but it is long gone. How many of you have seen 40-year-old tractors sitting out in a pasture somewhere? Lasts a long time, right? You poop out the pizza, it's gone. The tractor sticks around. So here we go. What that decision today did is it led to a tractor on our island as opposed to a slice of pizza. Nothing today, but more in our bucket tomorrow. That tractor won't last just 1 year, 2 years, 3 years. It might last for many, many, many years to come and be a productive part of our production process to have a lot more pizza in the future. That's economic growth. That's changing our system around, thinking about the mix of consumption goods and capital goods. We learned from chapter 6 that the accumulation of capital will lead to some form of prosperity, likely. That was one of the mechanisms, along with the accumulation of knowledge and skills, all those things. Okay, questions or comments on that?
So where's the depreciation of the tractor?
It would be, from an economic standpoint, the loss of productivity of the tractor. So the tractor's breaking down, right? So when it was brand spanking new, it worked the whole season. Then those of you who are familiar with tractors, they start to get a little bit old and there's something wrong and this needs to be fixed and it's in the shop. If it's in the shop, it's not in your field, right? So we want to think about the loss of productivity of those machines over time. That's the depreciation part. Ultimately leading you at some point in time to say, sorry, this tractor's seen its better days. It's 50 years old now. Time for the junkyard. Okay, so here is some thinking about the wealth of nations. How we go from one time frame to the next. In a given year, we have resources at our disposal. So year one, if that's 2001, we have some choices to make. If we produce pizzas, they're pooped out. Right? So consumption leads to holes in the bucket of wealth. It was there, it gave us some happiness, we could get back to social well-being, all of that stuff. But when we think back to the brass tacks of it here, there's a lot of things that happen over the course of the year. Death, disposal, and depreciation. Death, disposal, and depreciation. Human beings die. Some people die that were part of the labor force. That takes away from our bucket there. However, there's new babies being born, right? So that's a flow variable. So we have the death rate versus the birth rate that's ultimately affecting our labor bucket, along with the decision of purchasing new machines, investment, or purchasing consumption. And the more flows we have that carry on to next time periods, hopefully the wealth of our nation continues to increase. All right. Last thing here, we touched on, I think last time, when we talked about what is our wealth. And so if you take the value of our real assets versus our financial assets, so a real asset is the tractor, a car, a computer, usually tangible things you can touch. So the value of our real assets plus the value of financial assets, subtract off any debts that we have, which in this case might be a debt to China, but if we owe another American, that kind of washes, right? So one American's borrowing versus another American's lending washes with each other. If we're thinking about the prosperity of our island, we don't really need to count that for this type of analysis. What we're thinking about is who do we owe that's not on our island? And so we'd subtract off the liabilities, the money owed to other nations or the rest of the world, and we end up with our net wealth. And how does that change over time is affected by the decisions we make at each point in time. Okay. That's my tractor. Oh yeah, that was kind of a little fun thing I did. You see the pizza disappear? It like poops and gone. Then the tractor stays in the bucket. Going to the next thing. Okay. All right. So we got this equation to lay on you. And before you get too scared, it's not too big a thing. If you kind of understood me walking through that stuff, that's what this equation's saying. The amount of investment in the United States, the number of tractors being purchased, so the amount of investment has to be equal, this is kind of like our exports equal imports, has to be equal to the savings that's being done. And that comes from these three sources that we've identified. Private savings by households, government savings, if there is any, if they're not taking away from somebody. So we got T minus G. If tax revenues are greater than spending, then this is a positive number, and that's helping fund purchases of tractors. And then finally, foreign savings. Notice that we flip these two around, so take a little bit of note on that. Our net exports is this expression, exports minus imports. But what we were short on for exports must have been funds that came into the United States in the form of savings. So we're calling that foreign savings, and it's the flip of those two things. That is what funds the flow of investment in a given time frame for the United States and ultimately determines the bucket level of capital, along with depreciation that may have occurred. Okay, so have that formula down. Any questions there? Okay, so G is greater than T. Might be a problem. Makes this a little bit less. And that is it for that one. So I want to bring this back to the market we started to set up last time, the loanable funds market. Lost my gizmo. There we go. So last time I left you with a supply and demand framework. And we had the supply of loanable funds coming to us from households on net and the demand for loanable funds, mostly businesses wanting to buy tractors. All right, so on the vertical axis, we need to spend a little bit of time talking about the real interest rate, which will have a little r associated with that. The real interest rate. So a lot of exciting things happen in econ class where the two lines cross. So we get some sort of equilibrium interest rate on financial assets. And if we just simply took the average, let's just say that this is 5%, just to pick a number out of thin air. So the interest rate is 5%, and that gets us a certain quantity of funds being exchanged. Let's just call it $1,000. That could be $1,000 million. It doesn't really matter. I just want to kind of motivate things with a number of dollars being exchanged between parties that are demanding them and parties that are supplying them. So this is our loanable funds market. Now, let me just leave that as loanable funds. Okay, so interest rates. When we see the word real, what has gone on likely? We've talked about the real wage, real GDP, now it's real interest. When you see the word real, what's gone on? There's been a price adjustment and inflation adjustment, right? So there's been an inflation adjustment to the interest rate. Now interest rates are a little bit different than the prices. We went through an example of a nurse making $90,000 a year. You know, we had 90,000. Here we're dealing with it in terms of a percent. So let's talk interest rates here. So first of all, let's not forget that this is the fraction of the amount borrowed or loaned, depending on which side of the equation you are on, the fraction of the amount borrowed or loaned that is entitled to the lender. I think this is easiest just to run through a little example. So, suppose that you save $100 in 2013 at an interest rate of 10%. How much do you have in 2014? 100 and what? 10. Okay, good. So you didn't forget about the principal. Sometimes people just say 10, but it's 110. All right, so if we break that apart in careful detail, you guys took 100 plus what to get 110? 10% times that 100, right, to get the 110. Now, those of you who remember this from algebra, I'm not even sure this is algebra, this might be a basic math function here. What can we do with this 100 from this equation? Subtract it, not quite. Cancel it, not quite. Factor it. Factor it is what I want to do. So if we take 100 times 1 plus 10%, everybody agree that that's a legitimate mathematical maneuver? I know some of you got to dust off some cobwebs here. So if we've got this as an expression of a multiplication problem, we've got 100 times 1 plus 100 times 10%. We're right back to what we had upstairs. Cool? All right. What we just did was an important formula for present value and future value that you really need to know, especially you business majors. I don't want you to graduate from Ottawa University without knowing this formula by heart. This is a biggie. We've got the present value of $100 times 1 plus the interest rate, which I'm going to use little I now, times or equals the future value. So, if I was to say, what's 110 bucks worth a year from you now, today, what would you say? What's $110 a year from now worth to you today? At 10%. What's $110 that you'll receive 1 year from now worth to you today? 100. That's using this thing to its power here. Is that the present value of a future value? We just do the math, slide this expression over, and we get the future value divided by 1 plus the interest rate. All right. One little thing here is if we have multiple years, if you let your $110 ride a second year, you would be putting 110 here times 1 plus I to the 10, right? And you'd let it ride another year, and you'd end up with $121 or something like that. So how we fixed the formula here is that this was actually raised to the 1 power. But you don't have to put the 1 there if it's raised to the 1 power. It was just 1 year. If it's multiple years, you need to put it raised to however many years that is. So that's where you get that n thing. So PV equals the present value. FV equals the future value. I equals, now I want you to be careful with this one, the nominal interest rate. This is the rate that the bank told you were getting. And indeed, you did get that. You got your $10 when you left it in your bank account for 1 year. The nominal interest rate, though. And then finally, N here is the number of years. All right. Let's add on to the story a bit. Let's call this part 2. If the McDonald's cheeseburger, if the price of a cheeseburger, let's call it CB, equals $1 in 2013. And inflation for 2013 to 14 is equal to 5%. How many cheeseburgers, all right, how many cheeseburgers can you buy with your new savings in 2014? So pull out your calculators if you don't have them handy. Uh-oh. How much money do we have in 2014 because we had saved the prior year? 110. So just want to make sure we're all clear on that. You've got 110 bucks, and how many burgers can you buy? How much, Taylor? 104. You got some decimals with that? All right, so how'd you get it?
We have to figure out what the new price of the cheeseburger is.
Okay.
You take $1 times 0.05.
Okay.
Get $1.05.
$1.05.
110 divided by $1.05.
So I got 110 bucks, and every cheeseburger runs me $1.05. And so I'm getting 104.76. So, in a sense, how many burgers could you buy the previous year? You had 100 you could buy, right? You had 100 bucks a year ago. Burgers were only $1 then, so you could have had 100 burgers. So what is your real interest rate from your 10% that you earned? What's the real interest rate? 4.76%, right? when we start thinking about interest in terms of purchasing power, we've converted it to the real interest rate. So in terms of cheeseburgers, I used to be able to buy 100. So if this is the 2014, in 2013, I had $100. But of course, the price of a cheeseburger was only $1, letting me buy 100 cheeseburgers. Notice I've got the quantity here. So my purchasing power of my saved money went up by 4.76%. So therefore, I am 4.76 cheeseburgers happier in 2014 because of my savings. Which means my real interest rate, which we're going to use the notation little r, is equal to how many more cheeseburgers I get. So my real interest rate is equal to my new amount of cheeseburger purchases. Maybe I'll do this in 2 steps. My new cheeseburgers quantity minus my old cheeseburger quantity divided by my old cheeseburger quantity, which is 104.76 minus 100 divided by 100. The whole thing collapses down to 4.76%. What we're saying people factor into their decisions up here is what the real interest rate is. They think about what the bank is offering, but then they also think about what's going on with inflation. Now, that was kind of the long way of going about calculating it. We have a shortcut. I love shortcuts. Maybe you guys do too. So, shortcut alert. This is called the Fisher formula. Named after a brilliant mathematician, economist guy that went a little bonkers. There's kind of a neat story. He invented ivory soap and ended up stripping naked and running around Yale crazy. Lost all his money in the stock market crash, and that's part of what drove him insane. He had his family invest in during the 20s. But before he went too bonkers, actually I'm not sure when he exactly invented this, he noticed something. He said, you know what? There's a connection here between thinking about purchasing power and the nominal rates and real rates. And that connection is simply that the real rate of interest is equal to the nominal rate of interest minus inflation. It's kind of a quick little shortcut. Notice that it's not perfect. If we use the numbers I've got here, and before I do that, let's go ahead and put on here the real rate of return or interest. I'm going to sneak that word return in here too, so you're hopefully not confused. You know, you think of it as a return if you were the lender, right? You think of it as interest if you were the borrower, but sometimes we think about it on, both sides. Are you the borrower or the lender? So we might say this is the real rate of return or the real rate of interest is equal to the nominal rate minus, of course, the inflation rate. And using the numbers that we just did in this example, we had a nominal rate of 10%. We had an inflation rate of 5%, giving you a real rate of return of 5. It is an approximation, 4.76. But for these type of numbers, it gives us a close enough proxy for that. So that's how we'll be thinking about interest rates in the loanable funds market. All right, let's call it a day there. I'll send out an email